Crypto just dumped hard, but I've confirmed that it's a trap. Now, 3 altcoins are lining up for a monster move. On Thursday's show, I told you I wasn't worried about the dip. By Friday, Powell proved us right at Jackson Hole. He pivoted the Fed's tone, and the market responded instantly. Bitcoin started pumping, but altcoins were on absolute fire. Through the weekend, the rally only got stronger. Ethereum even hit a new all-time high of $4,957 on Sunday. Sentiment was flying. Then everything flipped. In this episode, I'll walk you through what's happening step by step. Powell's bullish signal, what caused the massive dump, and the market reaction, the altcoin setups, and the quiet infrastructure that could soon power trillions. Guys, don't let the noise shake you. The picture hasn't changed. Let's get into it. Jerome Powell stepped on the stage at Jackson Hole on Friday and flipped the macro switch. He didn't say, "We're cutting." He didn't need to. The real signal came in one phrase. The balance of risks appears to be shifting. That tells you everything you need to know. The Fed is moving off inflation. The focus is now on jobs. Powell admitted the labor market's in a strange place. Both the demand for workers and the supply of workers are slowing at the same time. That's the setup for layoffs. And when layoffs hit, they hit fast. He also scrapped the old rule book. The Fed no longer needs to see the 2% inflation before acting. They're building room to cut, well, early, I guess you could say, even though Trump says he's too late, Powell. And the markets got the message. Traders quickly priced in 2 rate cuts before the end of the year. And global central banks aren't waiting. 15 of them already cut rates in May. Too late, Powell knows the Fed is trailing behind. But here's the bigger picture. US debt service costs are absolutely exploding. Treasury interest payments just hit $1.2 trillion on a 12-month basis. At this pace, they'll reach $1.4 trillion by 2026 unless yields drop. For that to happen, average government borrowing costs have to fall below 3.1%. The 5-year is still sitting at nearly 3.8%. That gap only closes one way. You got it, lower rates. And Powell's out in May. Trump's already said he plans to name the new Fed chair fairly soon. That pick is likely someone who favors faster rate cuts. Markets are already moving ahead of it. But guys, what you saw in Jackson Hole, this is the start of a new era, of a new Fed strategy. So why did Bitcoin dump after the most bullish Fed pivot in years? Guys, it came down to a single whale, believe it or not. In one move, this entity unloaded over 24,000 Bitcoin. That's $2.7 billion worth straight into the market. The sell wall was so massive that it triggered a $4,000 crash in minutes and wiped out more than $300 million in long positions in the span of an hour. Here's where it gets even crazier. The on-chain data shows that it's an OG wallet that received 100,784 Bitcoin about 7 years ago. At the time, the coins were worth 642 million, but today they're worth over 11 billion. Over the past 5 days, this same entity has sent 22,769 Bitcoin worth 2.59 billion to Hyperliquid for sale. At the same time, they've been rotating into Ethereum, buying 472,920 ETH worth $2.22 billion, and opening a 135,265 ETH long position. That's a $577 million leverage bet on ETH. Even after unloading billions, the whale still controls around 152,874 Bitcoin valued at more than $17 billion. The market impact is obvious. Bitcoin's weekly candle just closed an ugly $112,185. And now traders are watching that $108,000 key level as a next test. This was one of the biggest single entity moves we've seen in years. And the message is clear. A deep pocketed whale is shifting billions out of Bitcoin into Ethereum. Aren't you guys glad that we did this months ago before even these insider whales are doing it now? So logically, you might be wondering, so where are we in this cycle right now? For years, Bitcoin's 4-year cycle has been like clockwork. The peak in 2013, again in 2017, again in 2021. Each one followed the same pattern: a halving, then a supply shock, then a blow off top about 12 to 18 months later. If that pattern holds up, we're due for a top sometime around Q4 2025. And that's a framework a lot of people still follow, and we're watching that very closely. But here's the thing, this market doesn't look or feel like the last three. Retail isn't leading anymore. Institutions are here now. ETFs, pensions, corporate treasuries, these players move slower, accumulate steadily, and they don't all panic out the moment the price pulls back like 15% or something. That changes the rhythm. The structure has shifted. On-chain cycle top metrics like MVRV, which we've talked about before, well, those were built around the retail cycles. They weren't designed for systemic flows. At the same time, Bitcoin still trades below its last cycle high when priced in terms of gold. There's no bubble here. It hasn't even broke out of relative hard money yet. And then there's the Fed pivot, guys. Powell's term ends in May 2026. Trump has said he'll announce his next Fed chair pick fairly soon. If that announcement lands later this year or early next year, it could fuel months of front running. Just like we saw during the Yellen to Powell handoff in 2018. Stocks rallied straight through the transition. Same thing during the Bernanke and Yellen shift as well. The sell-offs only came after the new chair took over. That puts a potential top closer to mid-2026, not next spring. There's another signal that's working quietly in the background as well. The stablecoin market cap. Stablecoins are crypto's version of the M2 supply. When the market tops, stablecoin growth usually stalls 3 to 6 months before. Right now, that growth is still climbing. That means capital is still coming in. Dry powder is building. The biggest risk to this extended thesis? Digital asset treasuries, guys. Strategy, SharpLink, ETHZilla. If any of these start liquidating instead of accumulating, the unwind could flip the entire picture in a massive way. It's one thing for ETF demand to stall. It's another when major holders become forced sellers. And there are also signs that some of the MNAVs have already slipped under 1. If those companies lose buying power or face redemptions, that matters. But as long as they're stable and still buying, this market stays supported. And the macro environment is still in the Goldilocks zone. Inflation hasn't reaccelerated. The Fed is opening the door for cuts. The macro is tilted toward risk assets. That doesn't guarantee new highs tomorrow, but it does give crypto a longer runway than we've ever had before. If the cycle is really getting stretched by institutions, then Ethereum is the one feeding it first. We're watching a whole new class of buyers lock up ETH. ETHZilla just filed a $10 billion stock offering with the goal of acquiring even more ETH. And Bitmine added 190,500 ETH last week, boosting their holdings by 2.2 billion to a total of 1.71 million ETH. Their 8.8 billion combined crypto and cash holdings makes them the largest Ethereum treasury globally and the second largest crypto treasury overall, only behind Strategy. SharpLink Gaming continues to send large amounts of ETH into ETH2 staking deposit contracts, removing it from circulation and locking it up for yield and network security. At the same time, Ethereum activity is rising. L1 transactions and active addresses just hit all-time highs, but gas fees are near historic lows. That's the best of both worlds. On-chain volume is strong, yet it's cheap to move. The cost to accumulate and deploy capital across Ethereum has never been this efficient, but the supply side is what's wild. As mentioned, whale wallets that were previously dormant are rotating Bitcoin into ETH. Bloomberg's trending stocks include names like SBET, BMiner, and ETHZ, all tied to Ethereum treasury companies. This changes how Ethereum trades. It's becoming the digital asset institutions want on their books, either directly or through proxies like corporate treasuries. That forces a new kind of supply squeeze. So if Ethereum treasuries and whale rotations are tightening supply, SharpLink is the one showing us how it gets weaponized. Right after locking ETH into staking, SharpLink's board approved a $1.5 billion stock buyback program. That raised a lot of questions. Why buy back your own stock after raising so much capital to buy ETH? Well, guys, here's the playbook. It all revolves around NAV, net asset value per share. Think of NAV as a company's balance sheet broken down per share. Take everything SharpLink owns, its ETH, its cash, its other assets, subtract its debts, and then divide that number by the total of shares in circulation. That's NAV. It's basically the fair value if each share of the company were liquidated today. When SharpLink trades above NAV, they can sell new shares at a premium and use those proceeds to buy more ETH. That increases the size of their treasury and gives them more exposure to buy ETH. When the stock trades below NAV, they flip the strategy. They start buying back their own shares in the open market. This is where it gets powerful and, in my opinion, a bit dangerous. They can fund those buybacks with cash they already have. Money left over from when they sold shares earlier to raise capital, or even loans backed by their ETH holdings. They don't need to sell a single token. The goal is simple: reduce float, increase ETH per share, and let the market reprice their exposure. Every time they shrink the share count without touching ETH, each remaining share becomes more valuable. They're using public equity to create a synthetic ETH leverage. It's dynamic, it adapts to market conditions, and it creates a long-term squeeze on circulating supply. This is the same framework that MicroStrategy used to accumulate Bitcoin. The difference is that ETH also generates yield through staking, has deeper programmability, and lives at the center of DeFi. As long as their NAV stays close to ETH's fair value, this playbook can run for years. But I gotta tell you that, to be honest, this kind of leverage financial engineering does concern me, and it's something that others have vocalized as well. This could be one of the biggest collapsing cascades when the market starts to turn around and this ETH value drops down. These companies might be in big trouble. But for now, it's bullish. So while SharpLink and other treasuries are ramping up their ETH accumulation, something strange is happening on the ETF side. Ethereum ETFs just saw record outflows, $578 million pulled out in a single week. That should be bearish. That should have tanked the price, but instead, ETH hit a new all-time high. It pushed above $4,900 with one of the biggest redemptions on record. This is where the dynamic is changing. Right now, even when ETFs bleed, ETH keeps climbing. That tells us something else is absorbing the supply, and it's happening off exchanges. The marginal buyer has changed. It's no longer just funds rebalancing through spot ETFs. It's corporate treasuries and whales buying and staking. It's long-term holders taking ETH out of circulation. These players are shrinking the supply before it even hits public markets. That's why outflows can spike and the price still rips. There is a hidden demand layer underneath this market. While Ethereum has been pulling attention at the top of the market, Solana has been building quiet momentum. Right after ETH hit new all-time highs, the Solana Bitcoin chart printed a clean W bottom on the weekly time frame. That kind of pattern happens when capital starts rotating. The Sol ETH pair also bounced right off monthly support, suggesting that Solana could begin to outperform ETH here, especially if ETH runs into resistance and consolidates. The technicals are there, but the fundamentals are what makes this compelling. Solana has been quietly outperforming across almost every metric that matters. It's top 2 in fee revenue, developer activity, transaction volume, and daily users. And it's doing this with a unified state machine, fast finality, and experience that keeps builders on chain. 0xMert laid it out clearly. This is the only chain executing at this level across product, UX, and raw speed. Solana doesn't need to beat Ethereum to win, and every tech cycle, the top 2 or 3 platforms capture nearly all of the value. You got iOS and Android, AWS and Azure, for example, right? Solana is gunning for one of these slots. The timing also lines up. ETH's been in the spotlight for months between the ETF flows, the treasury squeeze, and all the attention on staking yield. But when ETH rallies hard and traders start rotating, the next stop is usually Solana. You can already see it in volume. You can see it on the Sol BTC chart as well. This is how alt season rotation begins. And now the big players are stepping in. You got Galaxy, Jump, and Multicoin, who are reportedly working to raise $1 billion for a Solana-focused digital asset treasury. These are some of the sharpest investors in all of crypto. Funds have constantly front-run every major move for years. When guys like this go big, you probably shouldn't fade them. You've also got Sharps Technology, a NASDAQ-listed company that just announced a $400 million private placement expected to close on August 28th. They've signed an LOI with the Solana Foundation to purchase $50 million worth of SOL at a 15% discount. Part of their plan is to establish the largest Solana treasury on record. To me, Solana definitely has a different value proposition for Ethereum, right? They're both smart contract platforms, but they serve different markets. Ethereum seems to be the institutional DeFi play. Solana is like the everything else kind of app play. In my opinion, both have value and both are gonna run super hard, I think, over the next few months. Not financial advice, none of this ever is. Of course, do your own research, but this is just what these indicators are telling me. So while Ethereum is squeezing supply and Solana is flashing rotation, there's one protocol I called out a few weeks ago and it broke out shortly after. But the main move, guys, it hasn't happened yet. People are just waking up to the fact that this project might end up powering everything. Chainlink has been rebuilding in the background and most people have no idea how big the shift actually is. This is no longer just about price feeds. This is real infrastructure. Chainlink's new endgame vision lays it out clearly. They're building a unified Oracle platform they're calling the TCP/IP layer for on-chain finance. Think about what TCP/IP did for the internet. It stitched together disconnected networks so people could send packets anywhere, anytime. Chainlink wants to do the same for blockchains, and the systems blockchains still don't connect to. That includes Swift, DTCC, Fedwire, Fix, and all the legacy databases that handle everything from clearing and settling to regulatory reporting. These outdated networks are moving trillions of dollars on decades-old technology. Chainlink is building a complete system that can handle everything finance needs in one place. That means moving money, moving data, checking regulations, verifying identity, keeping things private, and even running calculations. For developers, it means they'll be able to build financial apps that work across different blockchains and even across different countries without having to patch everything together manually. One system, one framework, everything connected. Catfish Fishy explained this perfectly on X. Blockchains are just pure hosted databases. Even if you connect Ethereum to an L2, you're still stuck inside one chain cluster. That still doesn't solve the bigger problem of getting every system to actually work together. Real integration requires a bridge between on-chain assets and the off-chain infrastructure. Here's where it gets really interesting for Link. Chainlink just upgraded its economics. Now, whenever people use Chainlink services, like sending messages between blockchains or getting live price feeds, the system earns revenue, and that revenue gets used to buy Link tokens off the open market. The more Chainlink gets used, the more Link tokens get taken out of circulation. Less supply, more demand, that's what creates upward pressure on price. The bigger Chainlink gets as infrastructure, the more reflexive the token becomes. Chainlink is already working with Swift. Their chief innovation officer said it himself. The only question is, who else is paying attention? You guys are. Because once this layer becomes standardized and Link becomes the economic layer powering it, the repricing will be absolutely brutal. And guys, this is what we've known for years. This is why I made that video a couple years ago telling you I was making a huge bet on Link. It's finally coming to fruition. For these protocols to move out of just pure speculative value into real world value, this is what you're witnessing right now with Chainlink. It's finally going to have real utility driving the price more than just what people are speculating might happen one day. This is it. This is the moment you're watching it in real time. And here's the part that most people miss. Macro shifts like Powell's don't play out overnight. They unfold quietly and then all at once. When they finally surface, the capital that moved early gets rewarded the most. Right now, the signal is that major crypto supply is tightening just as liquidity wants back in. That's rare. That doesn't happen often. And when it does, the market tends to reprice faster than most people expect. That's the reason that I stay bullish, why I'm still not worried, and why my thesis, guys, has not changed just one bit. So the real question now is this: are you positioned for that repricing, or are you going to get shaken out by the noise, guys? You're not going to do that, right? If this episode helped you guys see the bigger picture, do me a favor, destroy that like button, hit subscribe if you're new to the channel. Welcome, my name is Kyle. It's great to have you guys here. And drop a comment below. What are you guys leaning into next? Bitcoin, ETH, Sol, Link, or something else that I missed? We are ahead of the wave, as we always try to do on this channel, guys. Let's stay there. I'll catch you guys in the next one. Until then, stay sharp, stack your Satoshis, some ETH, probably some Sol, and some Chainlink. See ya.